Let me be very clear with you right from the start. If I woke up tomorrow morning and the stock market was down 50%, I wouldn't panic. I wouldn't wait for the news. I wouldn't ask anyone what to do. I would already know exactly what I'm buying because I've lived through this before, more than once. I've watched markets collapse, fear spread, and trillions of dollars disappear, and I've learned that moments like don't destroy wealth, they transfer it. Today, I'm going to explain how I think during crashes and why the people who prepare before the panic are the ones who come out ahead. I'm David Tepper, and I've spent my entire career operating in uncertainty, financial crisis, credit freezes, recessions, panic selling. I've seen them all. And if there's one thing I know with absolute certainty, it's this: market crashes are not rare accidents. They are a permanent feature of investing. They always feel unprecedented when they happen. They always feel worse than expected, and they always convince people that this time is different. It never is. Every crash has a different story, but the psychology is always the same. Fear overwhelms logic. Prices disconnect from reality. And investors stop thinking about businesses and start reacting to headlines. That reaction is what creates opportunity. Most people believe the goal during a crash is to avoid losses. That's the wrong goal. The real goal is to position yourself for what comes next. Let me explain something most investors never truly understand. Stock prices are not the economy. They are not businesses. They are emotions expressed in numbers. During crashes, emotions dominate. Rational analysis disappears. Investors stop asking, what is this business worth? And start asking, how much worse can this get? That's when prices overshoot to the downside. I've seen outstanding businesses cut in half, not because their earnings disappeared, not because their competitive advantages vanished, but because people needed to sell. Margin calls, redemptions, panic. Forced selling has nothing to do with value. And that's the moment prepared investors wait for. Now, let me be clear, I'm not talking about blind optimism. I'm not saying buy anything that falls. That's how people get wiped out. The reason crashes reward some investors and destroy others comes down to one word: preparation. By the time markets are already down 40% or 50%, it's too late to start thinking clearly. Your brain is under stress. Every headline is negative. Every chart looks terrifying. Your portfolio is bleeding. You're not in a mindset to make rational decisions. That's why the real work happens before the crash, before the panic, before the headlines, before the fear. You decide in advance what businesses you trust, which ones you'd love to own at lower prices, how much you're willing to deploy, and under what conditions you'll act when you've done that work. A crash stops being confusing. It becomes mechanical. You're not guessing. You're executing a plan. Most investors never do this. They wait for the crash and then ask, what should I buy? That's exactly backwards. By then, emotions have taken control. Let me also kill a dangerous myth right now. You do not need to predict crashes to profit from them. I've never known when a crash was coming. No one does. Trying to time market tops is a waste of energy. What matters is how you behave when a crash arrives, not whether you saw it coming. The investors who succeed are not the ones with perfect timing. They're the ones with the right temperament. And temperament beats intelligence in this business. I've watched brilliant analysts panic at the bottom. I've watched average investors quietly build fortunes by staying disciplined. Crashes expose who actually understands risk and who only pretends to. Here's another uncomfortable truth. The media makes crashes worse. During normal times, financial news is background noise. During crashes, it becomes emotional fuel. Every headline screams catastrophe. Every expert predicts further collapse. Every chart points straight down. And human beings are wired to avoid danger. So what do most people do? They sell, not because the business is worse, because they can't tolerate the emotional pain. That selling pressure pushes prices even lower, creating opportunities for those who can remember one simple fact: great businesses don't stop being great just because the stock market is panicking. Factories don't shut down because the S&P falls. Customers don't disappear because CNBC is bearish. Cash flow doesn't evaporate because investors are scared. The business continues. Only the price changes. That distinction is everything. If you can separate price from value, crashes become less frightening and more interesting. Now, I want to address something critical. Crashes don't reward bravery. They reward conviction. Bravery without understanding is gambling. Conviction comes from deep knowledge. If you don't truly understand a business, how it makes money, Why customers stay, what protects it from competition. You will not hold it during a crash. You might tell yourself you will. You won't. Surface level confidence evaporates under pressure. That's why I focus on businesses I can explain simply. Businesses that don't rely on perfect conditions to survive. Businesses that generate cash in good times and bad. Those are the only ones worth owning when fear takes over. And this brings me to the most important mindset shift of all. Crashes are not about catching the bottom. I've never caught a bottom. Not once. If you wait for things to feel safe, you'll miss the recovery. By the time the news improves, prices have already moved. The difference between buying 10% above the bottom and buying at the bottom is meaningless over 10 years. The difference between buying during the crash and not buying at all, that's life changing. This is why preparation matters so much. When you already know what you want to own, fear loses its power. You're not reacting, you're acting. In the next segment, I'm going to walk you through the exact filters I use to decide which businesses are worth buying during a crash and which ones to avoid completely. Because not all bargains are opportunities, some are traps. And knowing the difference is what separates investors who survive crashes from those who profit from them. Before you ever buy a single stock in a market crash, there's one mistake that will wipe you out faster than anything else. Buying something just because it's down. That's not investing. That's gambling with fear. In this segment, I'm going to show you the exact framework I use to decide what is worth buying in a crash. And just as important, what should be avoided no matter how cheap it looks. Let's get something straight right away. When markets crash, most stocks deserve to fall. That's the part nobody likes to admit. A falling price does not automatically mean value. In many cases, it's a warning. During crashes, weak businesses don't just go down temporarily. They disappear. They get diluted. They get taken over. They go bankrupt. So before I ever buy anything in a panic, I run it through 5 filters. If it fails even one, I move on. There are no exceptions. Filter A1A, the business must survive. No debate, this is the most basic rule. And yet it's the one investors violate the most. I'm not interested in companies that might survive. I want companies that almost certainly will. That means no excessive debt, no reliance on cheap capital, no business models that only work in perfect conditions, crashes expose fragility. If a company needs refinancing every year, it's dead in a crash. If it depends on constant growth to service debt, it's dead. If customers can easily walk away, it's dead. I want businesses that people keep using even when times are hard. Payments still get processed. Phones still get used. Groceries still get bought. Insurance still gets paid. Survival isn't optional, it's mandatory. If you get this wrong, nothing else matters. Filter A2A, a real competitive moat. Not a story. Every CEO says their company has a moat. Most are lying. A real moat shows up in behavior, not words. Ask yourself, can customers easily switch? Can competitors undercut pricing? Can a new entrant replicate this business in 5 years? If the answer is yes, there is no moat. Real moats look like this. Brands people emotionally trust in networks that get stronger as they grow cost structures. Competitors can't match regulatory barriers that block entry. Don't just protect profits. They protect time. Time allows compounding to do its work. Without a moat, even a cheap stock can be a bad investment. Filter when 3D strong. Consistent free cash flow. I don't fall in love with revenue. I don't fall in love with projections. I fall in love with cash. Free cash flow means a business pays its own bills, funds its own growth, survives without begging markets for money. During crashes, capital becomes expensive or unavailable. Companies that rely on refinancing lose control. Companies with cash gain power. Cash gives management options. Buy competitors, buy back shares, invest through the downturn. No cash, no control. And no control means investors get hurt. Filter weight 40. Management that thinks like owners. This one is subtle and critical. Over long periods, management decisions matter more than market conditions. Great management allocates capital rationally, avoids ego-driven acquisitions, protects shareholders, thinks in decades, not quarters. Bad management chases growth at any cost, overpays themselves, dilutes shareholders, panics under pressure, crashes, reveal character. I want leaders who stay calm when everyone else loses discipline. Because when fear hits, bad managers destroy value fast. Filter when 5A. Margin of safety, the only real protection. This is where crashes become powerful. Even the best business can be a terrible investment at the wrong price. The margin of safety is what protects you from being early, being wrong, short-term, unexpected bad news. When you buy a great business far below intrinsic value, Time works for you. You don't need perfect timing. You don't need immediate recovery. You just need patience. That's how fortunes are built. Obleć why most I envy stars fi TSE feltars. Here's the uncomfortable truth. Most investors don't fail because they lack intelligence. They fail because they lack discipline. They chase what's fallen the most. They buy what feels cheap. They ignore balance sheets. They ignore business quality. Crashes punish that behavior brutally. A stock down 70% can still go to zero. A stock down 50% can still be overvalued. Price alone means nothing. Quality plus price is everything. The mental shefty yu maasti make. Let me give you a mindset that will save you years of pain. Stop thinking like a trader. Start thinking like a business owner. Ask yourself, would I be happy owning this entire business? Would I hold it if markets stayed closed for 5 years? Would I want more of it if it got cheaper? If the answer isn't a clear yes, don't buy it. Crashes don't require speed. They require clarity. Our next video, now here's where this gets interesting. When I apply these 5 filters, survival, moat, cash flow management, and margin of safety, almost every stock gets eliminated, but 4 stand out. 4 businesses so durable, so powerful, that a 50% crash wouldn't be a warning sign, it would be an invitation. In the next segment, I'm going to walk you through the first 2 stocks I would buy aggressively in a market crash, and why most investors completely misunderstand how strong these businesses really are. Trust me, this is where the real opportunity begins. Let me warn you right now. When I tell you the first 2 stocks I would buy in a 50% market crash, many people will say they're too obvious. That reaction is exactly why most investors miss the best opportunities. Because in crashes, the greatest businesses don't disappear, they go on sale. And the people who understand that distinction are the ones who win. Now that you understand the framework, let's talk about execution. When markets crash, I'm not looking for clever ideas. I'm not looking for what's new. I'm not looking for what's exciting. I'm looking for certainty. Certainty that the business will still be dominant years from now. Certainty that customers won't disappear. Certainty that cash will keep flowing. When I apply that standard, 2 companies rise immediately to the top. When let me say this clearly. Apple is not just a technology company. It is one of the strongest consumer businesses ever created. People underestimate Apple because they think in terms of devices. That's a mistake. Apple didn't build products. Apple built an ecosystem, and ecosystems are incredibly hard to break. Over 1 billion people around the world carry an iPhone every day, not because it's the cheapest option, but because it's the best experience. That tells you everything you need to know. This is not price-driven demand. This is emotional loyalty. Switching away from Apple isn't just inconvenient, it's painful. Photos, messages, apps, subscriptions, habits, everything is connected. That lock-in is a moat most businesses can only dream of. And here's what most investors miss. The real power of Apple today isn't hardware, it's services. Apple collects money every single month from its installed base iCloud, App Store, Apple Music, Apple Pay, Apple TV Plus Fitness, Fit News. This revenue is recurring, high margin, and growing. It's predictable, it's sticky, and it compounds quietly. 10 years ago, services barely mattered. Today, it generates tens of billions annually, and it keeps growing without needing to sell more phones. That's the kind of revenue investors should crave in uncertain times. Now ask yourself this. If the market crashed 50% tomorrow, would people stop using their iPhones? Would they cancel iCloud storage? Would the ecosystem suddenly fall apart? Of course not. The business wouldn't be damaged. Only the stock price would be, and that's the opportunity. Apple generates enormous free cash flow, the kind that gives management options, buybacks, dividends, investment in future technologies. When you buy Apple in a crash, you're not betting on a rebound. You're buying ownership in a machine that keeps printing cash regardless of headlines. That's exactly what you want during chaos. Visa, now let's talk about Visa, one of the most misunderstood businesses in the market. Most people think Visa is a credit card company. That's wrong. Visa doesn't lend money. Visa doesn't take credit risk. Visa doesn't care if consumers pay interest. Visa is a toll booth. Every time money moves across its network, Visa takes a small cut. That's it. No inventory, no factories, no balance sheet risk, just volume. And the volume is massive, trillions of dollars every year. This business model is almost perfect. Visa's operating margins are extraordinary. A huge portion of revenue drops straight to profit, and the moat enormous. There are only 2 global payment networks that matter, Visa and MasterCard. To compete, a new entrant would need millions of merchants, billions of consumers, thousands of banks. That's not happening. The network effect is self-reinforcing. Merchants accept Visa because consumers use it. Consumers use Visa because merchants accept it. That loop is almost impossible to break. And here's another thing people miss. New payment technologies don't replace Visa. They ride on top of it. Apple Pay runs through Visa. Digital wallets still process Visa transactions. Even many disruptive fintech products depend on Visa's rails, so growth doesn't slow, it accelerates, and inflation. Visa loves inflation. Higher prices mean larger transaction values. Larger transaction values mean higher fees. Visa grows without lifting a finger. Now imagine a market crash. Spending might slow temporarily, but payments don't stop. The global shift away from cash doesn't reverse. Visa keeps collecting tolls. If Visa dropped 50% because of panic, that wouldn't reflect business weakness. It would reflect investor fear, and fear creates opportunity. Buying Visa in a crash is buying a global financial backbone at a discount. There's a reason Apple and Visa are my first buys. They share three critical traits. They are embedded in daily life. They generate enormous free cash flow. Their competitive advantages get stronger with time. These aren't cyclical bets. They're structural winners. You don't need heroics. You don't need perfect timing. You need patience. Now, here's where things get even more interesting. The next stock I'd buy in a 50% crash isn't a tech company. It isn't a financial company. It's a business most people completely misunderstand. And because of that, they underestimate how powerful it really is. In the next segment, I'll show you why this company thrives in both booms and recessions, and why a crash would turn it into one of the safest, smartest buys you can make. Don't miss this one. Let me tell you something that confuses almost everyone. The next stock I'd buy in a 50% market crash isn't flashy. It isn't disruptive. And it doesn't make headlines, but it might be one of the most resilient businesses in the entire market, especially when times get tough. And most investors don't understand why. When people think about investing during a crash, retail is usually the last place they look. Low margins, brutal competition, e-commerce pressure. On the surface, retail looks fragile, but Costco isn't a normal retailer. And if you don't understand that distinction, you completely miss why this business becomes incredibly attractive during market panic. Costco is not a retail business. Costco is a membership subscription business that happens to sell physical goods. That difference changes everything. Let me explain. Most retailers try to make money by marking up products. They buy something for 10, sell it for 15, and hope customers don't notice the markup. Costco does the opposite. Costco intentionally keeps prices as low as possible. Their average markup is around 11%. That's not a typo. They're not trying to maximize profit per item. They're trying to maximize trust. Why? Because Costco makes most of its profit from membership fees, not merchandise. This is the key. Millions of households pay Costco every year just for the right to shop there. And once they join, they almost never leave. Membership renewal rates hover around 90% and even higher in core markets. That's subscription revenue predictable, recurring, high margin, and it comes before a single item is sold. Now think about what that means in a market crash. Stock prices fall, consumer confidence drops, people become more price conscious. Who benefits? The business that offers the best value. Costco doesn't raise prices in downturns. It becomes even more attractive. Customers don't leave Costco when times are hard. They lean into it. And because the profit comes from memberships, Costco doesn't need to gouge customers to survive. That creates a virtuous cycle competitors can't replicate. Let's talk about competition. Why doesn't Amazon crush Costco? Because the Costco experience isn't just transactional. You can't digitize bulk grocery shopping, gas discounts, pharmacy services, optical services, tire centers, food courts. Treasure hunt. Feeling Costco isn't convenience retail. It's destination retail. People plan trips to Costco. They enjoy going there. That matters more than analysts realize. And the customer base, affluent, educated, loyal. These aren't desperate shoppers chasing pennies. These are households making a rational decision, pay a small annual fee to save thousands over time. That's a powerful habit. Now let's talk about management, because this is where Costco truly separates itself. Costco management thinks decades ahead. They pay employees well. They offer benefits. They reduce turnover. That sounds expensive until you realize it creates better service, better execution, and stronger loyalty. Costco doesn't chase short-term margins. They protect the long-term relationship. That discipline is rare, and it shows up in performance. Through recessions, inflation, pandemics, Costco keeps compounding quietly. Now imagine a 50% market crash. The headlines would scream, retail is dead, consumer spending collapsing, margins under pressure, and Costco stock would fall. Not because the business is broken, but because investors lump everything together. That's when I get interested. Because Costco's fundamentals don't collapse in a crash. Membership renewals don't disappear. People still buy groceries. Value becomes more important, not less. So what are you really buying when you buy Costco in a crash? You're buying recurring subscription revenue, one of the most loyal customer bases in the world, a cost structure competitors can't match, management that refuses to sacrifice long-term trust for short-term profit. That's not fragile. That's resilient. And resilience is what you want when fear takes over. Now let me zoom out for a moment because this is important. Notice the pattern across the stocks we've discussed so far. Apple, Visa, Costco, different industries, same characteristics. They are embedded in everyday life. They generate cash. They have loyal users. They don't rely on perfect economic conditions. That's not an accident. That's the profile of businesses that don't just survive crashes, they come out stronger. But there's one more stock I haven't talked about yet, and it's the one that gives you something no other company can during a market collapse. Liquidity, flexibility, optionality. It's the ultimate crash advantage business. In the final segment, I'm going to tell you the fourth stock I would buy in a 50% market crash and why this company doesn't just survive chaos, it uses chaos to make itself stronger. This is the stock that gives you offense when everyone else is playing defense. And if you understand why, you'll never look at market crashes the same way again. If you gave me one stock to own in a 50% market crash, just one, this would be it. Not because it's exciting, not because it moves fast, but because when everything breaks, this company becomes the buyer of last resort. And that's the most powerful position in finance. Let's get something straight. Berkshire Hathaway is not a stock. It's a financial fortress. And most people completely misunderstand why it becomes so powerful when markets collapse. People look at Berkshire and say, it's boring. It's old. It doesn't grow like it used to. That's surface level thinking. Berkshire isn't designed to be exciting. It's designed to win when others can't move. Here's the secret most investors miss. Berkshire's greatest asset isn't Apple stock. It isn't railroads. It isn't insurance companies. It's cash. And not just some cash. We're talking about hundreds of billions in liquidity. Cash that does nothing in bull markets and everything in crashes. Now ask yourself this, what happens in a 50% market crash? Banks panic. Funds face redemptions. Companies scramble for financing. Credit freezes. Everyone needs cash. Almost no one has it, except Berkshire. Berkshire doesn't sell assets in crashes. It doesn't deleverage. It doesn't beg for capital. It becomes the capital. This is where the advantage shows up. During crisis, Berkshire gets offered deals no one else can touch. Preferred shares, guaranteed yields, equity upside with downside protection. Goldman Sachs in 2008. Bank of America during the financial crisis. Occidental Petroleum more recently. These weren't lucky bets. They were structured deals made from a position of absolute strength. And here's the key insight. Berkshire doesn't need markets to recover to win. It gets paid to wait. That's a rare thing. Most investors need prices to go up. Berkshire needs time to pass. Let's talk about the insurance engine, because this is the quiet monster inside Berkshire. Insurance companies collect premiums today and pay claims later. That gap creates something called float. A Berkshire's float is massive and low cost. That means Berkshire gets to invest other people's money for free, sometimes even at a profit. In a crash, that float doesn't disappear. In fact, it often grows. So while other investors are forced sellers, Berkshire has fresh capital flowing in. That's asymmetric power. Now let's talk psychology, because this is where Berkshire really shines. When markets collapse, fear dominates. Most CEOs panic. Most boards freeze. Most investors want to hide. Berkshire's leadership has seen it all. Crashes, inflation, wars, recessions. They don't rush. They don't react emotionally. They wait for mispricing. And mispricing explodes during crashes. Great businesses trade at ridiculous valuations. Strong companies get desperate. Entire sectors get written off. Berkshire steps in when risk is highest, because that's when reward is mispriced. Now think about what you're really buying with Berkshire stock. You're buying a diversified portfolio of real businesses, massive deployable cash reserves, a proven crisis playbook, the ability to profit from volatility. Not fear at Berkshire doesn't need perfect timing. It needs disorder. And disorder is exactly what crashes provide. Now let me tie everything together, because this matters. The 4 stocks we've talked about aren't random picks. Apple gives you ecosystem dominance. Visa gives you toll booth economics. Costco gives you trust-based recurring revenue. Berkshire gives you liquidity and optionality. Different strengths, same outcome. They don't break when pressure hits. They bend, adapt, and compound. That's how real wealth is built, not by predicting crashes, not by trading headlines, but by owning businesses that benefit from human behavior under stress. Here's the uncomfortable truth most people don't want to hear. Market crashes aren't rare events. They're recurring features. If you invest long enough, you will live through multiple 50% drawdowns. The question isn't whether they happen. The question is whether you're positioned to survive and take advantage. That's the difference between people who panic and people who quietly build generational wealth. If you remember one thing from this entire video, remember this: crashes don't destroy wealth. Bad preparation does. The real game isn't avoiding volatility. It's owning businesses so strong that volatility works in your favor. That's how professionals think. That's how capital survives. And that's how fortunes are built when others give up.